How are you doing this week, my friend?
Man, I'm good. This been a crazy week. We watched the two idiots running for presidential election, doing their things. One of them was a complete grease fire. Anyway, man, I say that because it's kind of a little bit of a segue into people getting concerned about the election. We're having a lot of people that should take action. I've got a guy right now, Spike, who is he retired. He's leaving his money in his 401k. His money is allocated largely to index funds. He's got a 20% bond exposure, so not a lot of bond exposure, which means 80% of his money is exposed to stock market risk. But he doesn't want to do anything until after the election. And I'm like, well, why is that? He's like, well, I'm concerned about the markets. And I'm like, well, does it make sense for you to sit in your 401k with 80% of your money exposed to stock market risk when you're worried about the stock market falling because of the presidential election, whether Trump wins or Kamala Harris wins or whatever, So it's Spike. It's important to remind folks during these election times that the winner of the presidential election has very little to do with movement of stock markets. In fact, if you go back historically, look at presidential election years, if a Republican takes over from a Democrat, the market is up in the election year, all right, which tells you right now that the market doing well this year is Trump may very well win this thing, like it wrong, right, or indifferent, but that's what the market simply tells you historically. And then in the following year, in the inauguration year, the market's flat. Well, in the Democrat year, when a Democrat takes over from a Republican, the market's usually a little bit down, right, or going down, and then is up in the inauguration year. Interestingly enough, if you look at both scenarios and you average out the inauguration year and the election year from Democrat and Republican, the difference is 1%. So, folks at home, don't let political views or political ideologies or feelings guide you when it comes to sitting on the sidelines in a 401k account trying to shield your money from market risk when it's fully exposed to market risk. It just, it just doesn't make sense. Anyway, just food for thought out there, folks.
Food for thought. You're stealing a little bit of my thunder, but I'm glad too. I guess it is your program
Spike,
and your video.
It's my job to steal your thunder. It's what I do.
You do, man, and you do it well. Because that's exactly what I was gonna say, and I was gonna ask you, is this because
what were you gonna say?
Run up?
What do you got to say?
The U.S. retirement market, the aggregate of retirement accounts, has reached over $40 trillion. And I was going to ask you, is this because of the market run-up? Are more people saving a little bit more aggressively, putting in as much as they possibly can? Or do you think they're still coming up shallow? We've got an hour-long radio program, but we're going to break this up into several videos for YouTube. But that's what was concerning me, exactly what you just said about this person who didn't want to change their asset allocation. $4.5 trillion of it is in IRAs, which can obviously either be from self-investing or rolling over 401k. $11.3 trillion in defined contribution plans, about $2 trillion in private defined benefit plans, et cetera, et cetera. But the vast majority of it still in mutual funds. The vast majority, not using exchange-traded funds and exposed to all this market risk. So if you are that person who is closer to retirement, is this a retirement risk that people aren't realizing? Just like your client that you were talking about doesn't want to move it.
Well, I mean, I think it is, Mike, and I think I'm hopeful that people are saving more and starting to realize that we do in fact have a retirement crisis in America. I mean, Google it, folks. It's real. It's here. It's out there, and retirement is coming your way, whether you are ready for it or not. It just happens. Spike, do you have mirrors in your house? Not a trick question.
Yes, I do.
We're on the radio.
Yes,
Can't have too big of a pause here, Spike.
Yes, I do.
Have you ever noticed something when you look in the mirror?
Yeah.
I do.
It's not the same face as when I was 25.
It's not the same face as when you were 25. I'm doing the, what do you call it, the phentermine spray, or not phentermine, finished red spray for my hair because I'm losing my hair. It gets grayer. I get another wrinkle here and there. Callie's got me using all this moisturizer stuff and trying to keep me looking good and young, But the bottom line is that we're getting older. And, aging is something that we can try to, fend off as long as we possibly can, but it's going to come our way, and which means retirement's going to come your way, whether you're ready for it or not. So the bottom line, Spike, is I am hopeful that people are, in fact, saving more. But what I believe is going on is the markets are knocking over all-time highs every day of the week. You pick up the Wall Street Journal or turn on CNBC or Fox Business News, whatever you watch, Bloomberg, and market's at all-time high. Again, market crossed over 40,000. This, market that.
43,000 right now. We'll see if it holds.
Yeah, it keeps going higher. So that's a lot to do with understanding something really important that I think people miss the boat on. The S&P 500 is primarily the gauge for the stock market, right? When people say the Dow Jones, that's 30 companies. A better barometer, so to speak, is the S&P 500. And the reason why that is it's 500 companies versus 30 in the Dow, okay? But the S&P 500 is a cap-weighted index, which means the bigger your company is, like a Microsoft, for instance, the larger percentage of the S&P 500 index your company makes up. So it's kind of something I think they should potentially revisit, because what's happened is these tech companies, largely focused in the AI space, have gotten so big, they're making up the majority of the S&P 500 return.
Doing a little bit of research, I was looking at semiconductor funds. And you are correct. Really, really heavily loaded into these companies that are looking at AI. My curiosity there is there a possibility of a 2000 with all of this AI and technology? It is increasing the growth in the markets right now. But is it real? Is it real growth that you think will stay? Or is there the possibility of kind of there was I don't want to say bait and switch, but the dot-com bust was that just because you had a .com behind your name didn't mean you were going to be a successful business. And that's kind of, everybody was investing in anything that was .com back then. And the companies that had proven abilities, like an Amazon, they stuck around and they grew and grew. Are we overly investing in companies that might not be there 5 years from now? What do you think about the increase in AI right now?
I don't think so, Spike. I think AI is here to stay. I use ChatGPT, for instance, a lot. I had to write a pretty heady article, or not article, but email recently, and I didn't like the wording that I was using, and I opened up ChatGPT, copied the email, pasted it, said write this from a kind of a legally proper point of view, and hit enter, and it spit this thing out, and I was like, holy cow, that sounds great, and that's just one thing of using ChatGPT to write an email response to someone, right? But it's one of these things where I think it is here to stay. And if you look at the stock, it's TSMC, Taiwan Semiconductor Manufacturing. They just had blowout earnings because of AI chips. So I think that playing the AI portion of the indexes or the tech sector is a smart play. And I think there's going to be some substantial wealth created as a result of that. In fact, I think last week, NVIDIA, I don't know if it was Wells Fargo or somebody else, but one of the big name coverage banks providing coverage to NVIDIA said NVIDIA can rally 40% from where it is today, right? And so I think it's here. I think it's real, and I don't think it changes. And I think people can make a lot of money. But the main thing is, as you get closer to retirement, folks, you've got to start de-risking, right? If you sit there at the blackjack table at the casino, and I've done it, by the way, and you run up a $500 bet, to $10,000, if you keep sitting there long enough playing, you're going to lose that money back to the casino. So at some point in time, it makes sense to pull some chips off the table, lock in some winnings, keep some money out there, play with the house's money, that's fine, but lock in some winnings and don't lose your retirement.
Yeah. For those of you who are listening to us on the radio right now, we've got to take a very short commercial break. We're going to continue this conversation, though. Over $40 trillion in assets in retirement savings. But for Gen X, who are 5 to 10 years away from their own retirement, how prepared are they? Is this a run-up because of the markets? Is this a run-up because we are saving more? Let's dig more into that when we come back on the radio and for our next video, so don't go anywhere. If you don't know how much risk you're taking, though, and you're that close to retirement, call the phone number. Call it right now. We'll do your portfolio review, your risk review. 844-944-7555. That's 844-944-7555. If you're listening on the radio, call that phone number right now. Or you can also go to retirenowhouston.com. That's retirenowhouston.com.